Hello guys, in this presentation we will discuss basics of technical analysis. Technical analysis is an alternative approach for making investment and trading decisions. Basically, technical analysis is forecasting of future financial price movement based on an examination of past price movement. It helps investor anticipate what is likely to happen to price over time. Price data refers to any combination of open, high, low, close, volume or open interest for a given security over a specific time frame. Time frame can be from few minutes, weeks, hours, days to months. Assumptions of technical analysis. First of all, high liquidity. Heavily traded stock allow investor to trade quickly and easily without dramatically changing the price of stock. Thinly traded stock are more difficult to trade because there aren't many buyers or sellers at any given time. So buyers and sellers may have to change their desired price considerably in order to make a trade. No artificial price changes. Artificial price changes like split, dividend and distribution can dramatically affect the price chart and make technical analysis difficult to apply. We need to adjust historical data prior to price change for making useful comparisons. Next, we have no extreme news. Technical analysis cannot predict extreme events like war, terrorist act, etc. When the forces of extreme news are influencing the price, it's better to wait patiently until the chart settles down and start to reflect the new normal that results from such news. Dow theory laid the foundation for what was later to become modern technical analysis. Dow theory was not presented as one complete amalgamation but rather pieced together. Three most important theorems are: first of all, price discounts everything. Market price reflects the sum knowledge of all participants including traders, investor, portfolio manager, buy side analyst, sell side analyst, market strategist, technical analyst, fundamental analyst and many other. Technical analysis utilizes the information captured by price to interpret what market is saying with the purpose of forming a view on the future. Next, price movements are not totally random. It is possible to identify a trend, invest or trade based on trend and make money as a trend unfolds. For example, when broad trend is up but it is also interspersed with trading ranges, the uptrend is renewed when stock breaks above the trading ranges. A downtrend begins when stock breaks below the low of previous trading range. Next, what is more important than why? Price is the end result of battle between forces of supply and demand for company stock. Objective of analysis is to forecast the direction of future price. By focusing on price and only price, technical analysis represents a direct approach. Let's now discuss strengths and weakness of technical analysis. Strengths. Focus on price. Price movements usually precede fundamental development. Periods of accumulation as evidence of an impending advances and period of distribution as evidence of an impending decline. Assist with entry point. Technical analysis can help spot demand and supply levels as well as breakouts. Simply waiting for a breakout above resistance or buying near support levels can improve returns. Next, historical price picture. It presents historical picture and it is easy to identify. Reaction prior to and after important events, past and present volatility, historical volume or trading levels, relative strength of stock versus overall market. Next, weaknesses. Analyst bias. Technical analysis is subjective and our personal biases can be reflected in the analysis. Next, open to interpretation. Two technicians will look at the same chart and paint two different scenarios or see different patterns. Both will be able to come up with logical support and resistance level as well as key breaks to justify their position. Next, too late. By the time trend is identified, a substantial portion of the move has already taken place. Next, trader's remorse. Even though many principles of technical analysis are universal, each security will have its own idiosyncrasies. In technical analysis, we arrive at investment decision by analyzing chart patterns, candlestick patterns, and indicators. First of all, chart patterns. There are three types of chart patterns: reversal chart pattern, continuation chart pattern, and bilateral chart pattern. First of all, reversal chart pattern. Here the trend, when exhausted, slows down, forms a pattern before they trend in the opposite direction. Early signal either to book profit or make a new entry. Few examples of reversal chart patterns are double top, double bottom, head and shoulders, and inverse head and shoulders. Next we have continuation chart pattern. These are consolidation pattern because they show how buyers or seller take a quick break before moving further in the same direction as the prior trend. Examples are falling wedge, rising wedge, bullish pennant, and bearish pennant. Next we have bilateral chart patterns. These are a bit more tricky because these signals that price can move either way. Place one on top of formation and another on bottom of formation. Example: ascending triangle, descending triangle, and symmetrical triangle. Let's now see various types of candlestick pattern. Popular one candle pattern are hammer, hanging man, shooting star, inverted hammer. Popular two candles pattern are engulfing, harami, and piercing. And three candle patterns are evening star, morning star, and doji. We will discuss technical indicators as part of technical analysis advanced presentation. Thank you.